Welcome. Today we're very happy to have Nicola Pavanini with us, who's going to be discussing the impact of alternative forms of bank consolidation on credit supply and financial stability. Just to remind you a couple of the rules of the seminar. So the seminar will go 45 minutes, and then we're lucky to have a 5-minute discussion by Daniel Paravicini. I messed that one up. He can tell you proper way to say that later. And that's going to be followed by a Q&A. So if you have any questions along the way, Nicola has built into his slides some downtime to ask these questions. So please type them into the chat, into the Q&A, and we'll read them. And during the breaks, we'll ask them and say who asked the questions. If you want to ask your questions at the end, your own questions during the Q&A, then there might be some possibility to do that too. Just let us know in your chat. And finally, the seminar will be recorded. So if you don't want to be recorded, then you shouldn't ask a question. Okay, Nicola, the floor is yours.
All right, great. Thanks a lot. So it's a pleasure to be able to present this paper at the seminar. So I want to thank the organizers for including it in the seminar series. And I also want to thank the organizers for organizing this whole virtual series that has been a great success so far. So what I'll talk about today is the impact of alternative forms of bank consolidation on credit supply and financial stability. This is joint work with Sergio Mayortomo and Emanuele Tarantino, who are both here in the audience. And given that we are using Bank of Spain data, the usual disclaimer applies. So the views expressed are those of the authors and do not necessarily reflect those of the Banco de España. So let me start with a little bit of motivation. So there's some theoretical literature that shows that a large number of undiversified banks, therefore a large level of competition in banking markets, can actually induce banks to take on too much risk. So to lend to borrowers that have a high riskiness. Now, if this high risk translates into non-performing loans or defaults, this can have potentially negative effects on the financial stability of the system, which might require public intervention with capital and government funds to recapitalize banks and using taxpayers' money. Now, one of the solutions that regulators used as a remedy for distressed banks in this overbanked system with a large degree of competition is to foster consolidation. This is a solution that has been adopted in various European countries like Germany and Spain will be the case that we'll look at, but it has also been used in the US with the auction process of the FDIC or in Japan after the banking crisis of the early 1990s. Now, bank mergers have some trade-offs that have some ambiguous welfare effects. On one hand, the positive side is that they can improve stability as merged banks being larger, they have a larger balance sheet, they can be better at absorbing losses. They can also generate efficiencies, so they can have a better level of risk management, for example. On the other hand, the standard antitrust authority view is that mergers can also generate market power, which can lead to higher prices or interest rates in the case of loans, lower credit supply, and this has been shown to affect particularly small and medium enterprises that are usually more opaque and more subject to asymmetric information problems. Now, measuring these trade-offs, quantifying the welfare effects of bank consolidation in general is a challenging task because of two reasons. One is that the decision to consolidate that banks might engage if they are induced by this by the regulator is endogenous after all, so they can decide to do it or not. But also because it's usually hard to separately identify the effect that market power, efficiency, and stability can have on some main outcomes of interest that we might want to look at, like credit supply, interest rates, or non-performing loans. What we try to do in this paper is to address these challenges and measure these trade-offs and welfare effects that I described using the 2009 Spanish banking sector restructuring program that targeted savings banks and induced them to consolidate. This involved almost all savings banks in Spain were induced to consolidate in order to receive public funds, so in order to be recapitalized by government money. Now, what is important for our story is that this program allowed for two types of consolidations. One is a standard merger or acquisition, and another one is a business group. Now, as I'll describe later, these two forms of consolidation share very similar efficiency and stability effects, but the M&A, the standard merger, turns out to have a stronger market power effect. And this will help us to tease out the effect of market power on some outcomes of interests. What's going to be crucial for our story as well is that the choice of this consolidation type that the savings banks made was actually driven by regional political motives that were orthogonal to the measures of market power, efficiency, and stability that I'll describe. So the contribution of our paper is to measure the impact of alternative forms of bank consolidation, this M&A and business groups, on credit supply and the credit performance. What we find is that M&A banks' market power, as you would expect in a standard antitrust view, reduces credit volume, reduces quantities, and increases interest rates or prices. But at the same time, and this is a novel finding that we bring in, it causes a reduction in non-performing loans. So this can be interpreted as market power resulting as M&As can improve banking sector stability. On top of this, we complement our analysis with a structural model of bank credit that we use to quantify the welfare effects of these alternative forms of consolidations and simulate some form of long-run efficiencies that consolidation can generate in order to increase the overall welfare of the banking system. So just to give you a preview of the results and be more specific, after consolidation, we find that M&A banks, relative to these alternative forms of consolidation, business groups, reduce credit supplies or reduce quantity by about 20%, and this corresponds to $45,000 euros per firm. They increase interest rates by almost 18 basis points or 5.3% relative to the baseline level of interest rates, especially for small loans and small firms. And also they reduce non-performing loans by 2.7 percentage points. So showing that M&A market power can have a beneficial effect for the banking system. Our welfare analysis instead shows that consolidation can have a short run and a long run effect. So we take the short run effect as being a case in which no cost efficiencies are generated because this takes some time to occur. In that case, only market power happens. And in this case, market power generates a 1.15 increase in banks' profits, especially for emerging banks, but overall also a 1% reduction in firm surplus. So the overall effect is actually a reduction in welfare of about 5 million euros. So slightly a small amount in welfare reduction. In the long run, instead, what we try to do is understand what kind of cost efficiencies bank might generate. And here we allow banks to reduce their marginal cost or reduce their own default risk, so become more stable, in order to keep the firm surplus at the pre-consolidation level. So be welfare neutral from the point of view of borrowers. And here we find that in order to keep firm surplus at the pre-consolidation level, consolidated banks will need to reduce their marginal cost by 5.4% of its standard deviation and reduce their own default risk by 56% of its standard deviation. We contribute broadly to three areas of literature: mergers in banking, mergers in IO, and structural models of financial intermediation. But I don't want to spend much time on the literature, and instead, I want to guide you through a simple stylized model that we use to illustrate how we think that consolidation can affect credit supply and the selection of borrowers or the performance of credit. And here we base our analysis, we borrow from a stylized model by Enhoff and Finkelstein applied to the insurance context, but we adapt it for a banking example. So we imagine here having banks that offer a unit loan at some price, some interest rate P. They face some demand from borrowers, some willingness to pay. And Q here is the fraction of borrowers that end up taking a loan between 0 and 1. We also assume that banks face some costs, some total costs, C of Q, and we can think of this as a proxy for non-performing loans. So the quality of borrowers that they attract, which eventually affects their costs. Now this will eventually also have a marginal cost and an average cost curve. The assumption that we make here is that a higher supply of credit, so when Q increases, there's a larger number of borrowers that take up a loan, leads to lending to riskier borrowers. So the idea here is that the marginal borrowers are riskier than the inframarginal ones. So the idea is that you might have an increasing cost schedule. So marginal cost and average cost curves increase as the quantity of credit in the economy increases. We will look at two benchmark scenarios in the stylized model. One is a perfect competition benchmark where the allocation is given when prices equal average costs, and a monopoly scenario where the allocation is given where marginal revenues equal marginal cost. The reason why we take these two benchmarks is to compare ideally the pre and post consolidation period within our example, within our data. So here's a graphical representation of the model that I just described to you. On the vertical axis, you have measures of prices and costs. On the horizontal axis, you have a measure of quantity. So the take-up of these loans, the share of borrowers that take up credit. You have a downward sloping demand curve and a downward sloping marginal revenue curve. As I described, we also introduce here upward sloping average cost and marginal cost curves that represent the riskiness of borrowers that banks attract. Now here we have two allocations, a competitive allocation QC and a monopoly allocation QM. As you can see, as is standard, A competitive allocation implies a larger quantity and a lower price relative to a monopoly allocation that implies a lower quantity and a higher price. But now the implication of this assumption of upward sloping cost curves implies that this market power effect of going from competition to monopoly also implies a reduction in average costs. So in the monopoly quantity, you have a lower level of costs, a lower riskiness of borrowers relative to the competitive one. Now, one problem with this analysis is that, as I described earlier, consolidation can also lead to some other forms of cost efficiencies. And this would imply, in the context of this graph, a clockwise rotation of these cost curves, which imply that for any given level of quantity, consolidation reduces cost because of efficiencies other than the selection of borrowers. For this reason, in our analysis, we will compare these two types of consolidations, M&As and business groups, because we claim that they both have very similar levels of cost efficiency, so they imply the same shift in the cost curves, but mostly M&A will have market power, which will allow us, therefore, to trace this variation in cost that comes from market power. Let me take a break here for questions.
Okay, there's no questions from the audience, but I have a quick question
Sure.
for you, if you don't mind. So when you're talking about higher supply, are you thinking in terms of euros or in terms of number of small businesses that are loaned to?
Both. In our empirical analysis, we will consider both. We will have, both.
And you allow those to imply differential risk profiles, I assume?
Yes, yeah.
Okay, thank you.
No problem. Okay, so I'll just move on and I'll start describing to you the data, the institutional setting, and the restructuring program. So we have data from the Bank of Spain, from its credit register, and most of our data is at the firm bank month level. So what we have is over 500,000 firm bank relationships that we can trace over time. And within this relationship, we observe the stock of credit exposure, how much money every firm receives from every bank, but also the share of non-performing loans within this relationship. We have information for almost 370,000 non-financial firms in Spain. We have their balance sheet information, and again, we can track them over time. And we have information on balance sheet of all banks in Spain, and we have a monthly information on the loan interest rates that they offer. So the information that we have for interest rates is at a more aggregate level relative to the credit supply, this credit exposure, or non-performing loans. Now, given that the restructuring program starts in November 2009, we will split our sample into two parts. One will be a pre-consolidation period between November 2007 and October 2009. And the other one will be a post-consolidation period that also includes the time of the restructuring program, but also some time after that, between November 2009 and November 2011. The reason why we stop at November 2011 is because that's right before the start of the European sovereign debt crisis, where Spanish banks received an extra liquidity injection because of that. So we don't want that event to be a confounding factor of the effect of this consolidation program. So the Spanish banking sector restructuring program was targeting mostly savings banks. And by 2009, savings banks represented a large fraction of the Spanish banking system, 40% in terms of assets. The problem, though, was that they had some structural issues that were threatening the systemic stability of the system. In particular, they were highly exposed to the construction and real estate sector for 217 billion euros. Almost half of that exposure was turning out to be problematic. For this reason, the Spanish government launched this restructuring program in which it was requiring savings banks to consolidate, present a consolidation program in order, in exchange, to get some public capital, some funds to recapitalize them. This public capital program went under the acronym of FROB. Now, savings banks accounting for 90% of total credit within the economy participating to the program, so they did some form of consolidation. The value of consolidating banks' assets was actually 1,300 billion euros. So this was a very large consolidation program. It lasted about 13 months between November 2009 and December 2010. And during that period, the number of savings banks in Spain went from 37 to 12. Now, what is important for us, as I said earlier, is that banks could choose between two forms of consolidation. One was the standard merger or acquisition. I would label that as M&A. And the other one was labeled as System of Institutional Protection, or SIP. And I will use this acronym for the rest of the talk. And this is essentially a business group. So let me describe what's the difference between these two forms of consolidation. Let me start from the similarities. So first of all, both of this type of consolidations share some identical features that were actually required by the regulatory guidelines of the restructuring program. First of all, they were jointly responsible for solvency. So all banks in the group were jointly responsible for everybody else. They had to file jointly their results, and they had to fulfill jointly all the regulatory duties. At the same time, they were induced to coordinate their risk management, which would imply that any information that any bank within the group had about any borrower would have to be shared with all other banks within the group. Third, they were induced to perform some organizational improvements and achieve some cost efficiencies that had to be similar regardless of which consolidation type they were to choose. Now, the key difference, which is important for us, is that SIP banks actually remain separate legal entities. So they didn't need to and didn't have to coordinate on credit policy. So they could choose interest rates differently among banks within the same group, choose credit supply differently. This implies that M&As would produce a stronger market power effect relative to SIP, because M&As instead are the same legal entity, so they need to coordinate by definition on credit policy. And SIP instead had this more decentralized nature that allowed them to have a lower degree of coordination on credit policy. At the same time, given the regulatory guidelines, they had to generate the same level of efficiencies. So in other words, this makes the SIP as a good control group for us to identify the market power effect of M&A, holding constant the effect on efficiencies and stability. Now, what is important is to understand what drove the decision of these banks to perform an M&A or a SIP. And our argument here, supported by anecdotal, institutional, and data evidence that I show you, is that the main driver were regional political motives. Why? Because savings banks had an institutional structure that implied a strong representation in their governing bodies of regional authorities. So politicians were sitting in the governing bodies of savings banks. Therefore, these regional politicians had an interest in keeping control of consolidated banks. Therefore, they pushed for M&As when banks were headquartered in the same region in order to keep the control of the new entity, of the new consolidated banks, and not lose control if the bank that they were controlling before consolidation would merge with a bank in another region, controlled by politicians of another region. At the same time, some banks didn't have any other bank within their region, for example, to merge with, or they had to form a consolidation no matter what. Therefore, the government allowed them to perform this business group, this SIP solution. And this happened between banks, therefore, headquartered in different regions. Now, this might seem problematic because this seems to suggest that the M&A banks had that previous larger overlap in their market share and credit exposure, given this regional difference between the two modes of consolidation. What we try to show is that this was actually not the case. So we try to make sure that M&A and SIP banks are comparable groups by verifying, first of all, that the province level overlap in their market share, in their exposure in terms of credit is not a driver of consolidation form. So regions are fairly aggregated measures of geographic units in Spain. There's 17 regions. Provinces instead are more disaggregated. There's 50 of them in Spain. And they're considered by antitrust authorities as a relevant market for geographic competition. Therefore, what we do is that we look at the province level overlap in market shares in banks that engage in M&A or SIP. Think of this as a proxy for the ex-ante local market power. And we show that this province level overlap doesn't explain the choice of consolidation of one type versus the other. The other exercise that we do to make sure that the two groups are comparable is that we take a large set of financial and economic characteristics of these banks, we split them into banks that perform one type of consolidation versus the other, and then show that there's no statistically significant difference in all of these outcome variables across the two groups. Last, we perform a test of the parallel trends in the main outcomes of interest, so credit supply, interest rates, and non-performing loans, for the two subgroups, for the two groups of banks, before consolidation takes place, and show that the trends are parallel, as you would expect. So let me start with the first analysis, the province overlap. How do we do that exactly? So we run a regression model where we have as dependent variable a dummy that takes the value of 1 if a group of banks perform an M&A, and 0 if a group of banks performs a SIP. We regress that on a set of controls and on a measure of savings banks ex-ante province level overlap. The way we measure that follows from the literature, from Erel's paper, but essentially we take a group of bank J in a province M, and we measure their overlap as the total credit of the second largest bank in the group over the total amount of credit within that province by all banks. The idea here is that if there's already a large bank in a province and we add the second bank, how much market share does it gain by consolidating with the second largest? So this is one potential measure of province level overlap. We use alternative measures that deliver similar results. So here are the regression outcomes that I wanted to show you. So the dependent variable in this first column here, as I said, is a dummy that takes the value of 1 if banks perform an M&A and 0 if they perform a SIP. And the main independent variable is this measure of credit overlap. And for us, it's important to show that there's no statistically significant effect in the degree of credit overlap on the decision to perform one form of consolidation versus the other. Down here, when we compare the mean level of overlap between banks performing an M&A and a SIP, we find again no statistically significant difference. What we do in this last column here instead is that we take the degree of credit overlap back in January 1995. This is the first year of data that we have from the credit register, and it's right after the deregulation of branches that happened in Spain. In that case, we do find a positive and significant effect of credit overlap back in 1995 on merger and acquisition decision in 2009. And that is explained by the fact that back in 1995, most savings banks were located around their headquarters, therefore concentrating in their original region. Whereas during the following 14 years, these banks expand across the country and across different provinces, ending up in a scenario in which their overlap before consolidation doesn't explain their choice. The second analysis that we do is taking a large set of financial and economic characteristics of these banks, like non-performing loans, total assets, capital ratio, and so on. And then we group M&A banks and SIP banks and take the average of all these outcome variables and then compare the difference between them and find no statistically significant difference in the average of all these economic and financial variables. We do the same thing when we compare the median values or we consider the main bank within the two consolidating groups or the standard deviation of these variables, and we still find no statistically significant difference. So they're not distinguishable in terms of observable characteristics. The last exercise that we do is that we look at the parallel trends in the three main outcomes that we want to use for our regression models. Quantity of credit on the left here, interest rate spreads on the right, and NPLs, non-performing loans over total loans at the bottom. You see two lines here. The gray line represents M&A banks, and the black line represents SIP banks. And here we compare before and after the restructuring program that starts at time 0. As you can see from this graph, there's parallel trends before consolidation happens. And of course, we have statistical tests to show that this is the case. So we have evidence beyond this graphical evidence. What is interesting to notice as well is that after consolidation takes place, M&A banks reduce their credit supply more relative to SIP. They increase their interest rate more relative to SIP, but they keep their level of NPL at a lower level relative to SIP. So I'm going to stop here for questions as well.
Yes, I think Alessandro has a question. If you want to ask it, Alessandro.
Oh, okay. Yeah, I was wondering whether it matters in any way in your analysis, the fact that some banks may be part of larger international groups while others may be only local banks?
Yeah, so that's a good question. So all the savings banks were actually local Spanish banks. They were originally relatively small. There's a group of commercial banks that were larger, some of them part of an international group like Santander. They're sort of outside our analysis because they're not really comparable relative to these smaller savings banks. So in that sense, we don't have really any banks that were part of this program that were large or international.
And I have a quick question too. So this relates to the to observable characteristics not varying across the banks, the M&As and the SIPs. If you have a similar pricing policy, then maybe you're more willing to, meaning the interest rates that you charge, maybe you're more willing to merge rather than, and if you don't have a similar pricing policy, then maybe you want to stay into a SIP. So then even if you didn't have this consolidation, you would still see differences in market power. To what extent do you think that matters?
Yeah, no, that's a good point. So, I mean, that's something we haven't checked, but we could be able to, we would be able to check. So we would need to find a way to, measure the pricing policies that they had before consolidation and whether that is to some extent different between the two. I mean, for our story, what matters is the parallel trend, because eventually it will be a a different diff. But yeah, I will need to think about ways of measuring, how their pricing policy changes or it differs before consolidation. Yeah.
Thanks.
Okay, can I go on? Yeah.
Yeah, continue. Yeah, thanks.
All right, so let me take you through the empirical analysis that we conduct. So we estimate various models in the paper. I will just summarize the 3 of them here, which are the most important ones. So we use the 3 models to measure the differential effects of these 2 forms of consolidation on credit supply and credit performance in the pre versus post period. So in a standard diff in diff setting. We will have 3 main outcomes: the growth rate in credit volume, which would be at the firm bank time level; the loan interest rates, which would be at the bank, loan type, and time level, so at the higher level of data aggregation. And then we will have the change in NPL at the firm bank time level. And here we will just focus on the post period. So we just focus after 2009. And the reason for that is that we don't want our result to be contaminated by loans that were originated before consolidation took place. So we want to compare the NPL, the default, of loans that were originated by banks that had already started their merging or consolidating programs. So this is a specification that we have for the first and the third model, the credit supply and the non-performing loans. So here, our unit of observation is a bank J, borrower I at time T. This is going to be the outcome. That could be the growth rate or the average level of credit or NPL. The main independent variables here will be this interaction between a dummy that takes the value of 1 if banks perform an M&A, and 0 if they perform a CEPR, and a post dummy that is 0 before November 2009 and 1 after. We include a set of controls like bank controls in terms of size and profitability, or firm controls in terms of leverage and liquidity taken at the beginning of the pre or post period. We will control for the injection of public capital that these banks receive, bank fixed effects, and now following the literature in order to control for any unobserved variation in firms' demand for credit, we will introduce this interaction between industry, location, size, and time fixed effects. So industry will be a SIC3, industry classification. Location would be the province, size would be the asset decile, and time could be either pre or post or the month. And this implies that the identification of our main coefficient of interest alpha here, which measures how M&A and CEPR differentially affect the outcome variable, comes from firms that are within the same industry, same location, same size, and at the same point in time. We also try with firm time fixed effects as alternative specification, and the results are still very similar. Now, for interest rates, the second model, we have a slightly different specification because of the different degree of aggregation of the data. So here we have information at the bank J level and time T. Our dependent variable would be the spread between the nominal rate and the 3 months Euribor. And then we were going to have the same independent variable as before, interaction between M&A dummy and post dummy, bank controls, injections of public capital, bank fixed effects, and time fixed effects. Let me show you the results on credit supply, the first model. So here you see 4 columns. In the first 3 columns, the dependent variable is the growth in credit between the beginning and the end of the pre-period and the beginning and the end of the post-period. But we also do the same analysis with the average monthly amount of credit. We also split our sample between either all the firms or just SMEs, small firms, or just large firms. And you can see that our results comes mostly from small firms. So the coefficient of interest alpha on the interaction term tells us that M&A banks after the merger reduce credit supply by 19.4% or 45,000 euros per firm more relative to CEPR. And this result is robust to a sequence of robustness checks that we run. So we try to exclude the largest CEPR bank called Bankia, which absorbed almost 40% of the total injections of public capital. Running the same model without that large bank delivers the same result. We also focus on a subset of provinces where there was a high market share for both types of consolidating banks, where market power might have been the strongest. We still find the same results. And we also pass the omitted variable bias test by Oster. For interest rates here, you see 4 columns. Again, the main independent variable is post times M&A. In the first 2 columns, we consider the weighted average of interest rate among 3 maturity buckets of loans, because that's the level of disaggregation of information that we have on interest rate for 3 different maturity levels. In the last 2 columns, instead, we keep these 3 maturity buckets separately, and we use weighted OLS. Further, we split the sample between small loans, so small loans targeted to small firms, less than 1 million euros, and large loans above 1 million euros, usually targeted to large firms. As before, we find that most of the result here comes from small loans targeting small firms. So if we look at the first column, for example, we can interpret this as saying M&A banks after the merger increase interest rates for small loans by 17.8 basis points. This is equivalent to 5.3% relative to the baseline level of interest rates before consolidation, more relative to SIP. And this again is robust to the exclusion of the largest SIP bank, which was this Bankia consolidated entity. Last, let me show you the results on non-performing loans. So here again, the first four columns have as dependent variable the percentage change in NPL between the beginning and at the end of the post period, the consolidation period. But we also do the same analysis with the average monthly level. We split the sample between small firms and large firms, and again find that most of the outcomes come from the small firms, as we found earlier. So if we interpret the first column here, we can say the M&A banks after the merger reduced the share of NPL by 2.7 percentage point more relative to SIP. These results are robust, do the same robustness that I showed you in the first model. But on top of this, we also ran a similar analysis where instead of using this measure of ex post risk, because NPL means default that has already occurred, we use measures of firms ex ante risk, so some form of credit score that banks have access to, and show that merging banks, banks that perform an M&A, were actually reducing credit more to ex ante risky firm relative to SIP banks. And so this is in line with this finding, but just using an ex ante measure of risk rather than ex post. On top of this, what we're worried about is that this reduction in NPL that M&A banks experience might imply a negative spillover to banks that were not part of the program. So for example, I get rid of some of my bad loans, but these bad loans get transferred to other banks that were not part of the program. And this would undo the purpose of the regulation to improve stability. We use data on loan application to show that this is not the case. So there's no spillover of this bad NPL onto other banks that were not part of the program. Last thing I want to say here is on the fourth column here. This is labeled as a small share. So this is a subset of the data for provinces where the market shares of M&A and SIP banks is very small, both before and after consolidation. So this is a scenario in which for M&As, there's not enough market power in order to generate the effect that we find in the other markets. For this reason, it's good for us that we find no statistically significant effect of M&A relative to SIP, because this shows that their change in NPL is the same between M&As and SIP when M&As don't have enough market power in order to generate the effect. Okay, I can stop here as well.
Okay, we have a question from Carlos Schnoten. First, just to clarify, the dependent variable is an interest rate spread, is that correct?
Yes, that's correct.
Okay, so could the larger spread, his question is, could the larger spread of M&A firms be due to the access to cheaper interest rate to fund loans?
So the Euribor was the same for all banks, if M&A banks had constantly had the same lower level of cost of capital relative to SIP, this should be taken into account by bank fixed effects as well. And on top of this, the injection of public capital that we observed by the government was equally spread among M&A and SIP banks. So I don't think this would be a concern.
Okay, thank you.
Okay.
I have a question as well, just to.
Sure.
I didn't write it. So do you know how much of all your results, how much of the variation is intensive margin, how much extensive margin? So how much of the changes, let's say in interest rates, are because they stop lending to some firms and not others, and so on and so forth? I mean, you have the data to do it. It's you're kind of wasting the data by not going into that direction a little bit at least.
Yeah, that's a very good point. So that's actually something that to some extent we do, because we run two separate sets of regressions. One has firm time fixed effects, which kind of requires firms to, in order to be identified, requires firms to have a relationship with the bank before and after the consolidation. So in that case, we kind of only look at the intensive margin conditional on being in a relationship with a bank. But this other fixed effects that we use, industry, location, size, time fixed effect, they actually incorporate also the extensive margin, because in that case, we don't require firms to be part of the, be borrowing from the same bank before and after. So in that case, comparing the two results can tell us something about intensive versus extensive margin. Now, on top of my head, I don't remember the exact difference between the two results, but we do have that in the paper, so I can get back to that. But that's a good point. Yeah, thanks.
Okay, Nicola, we have one more question that just came in from Mark Schaefer. When you say no statistically significant difference, how big is the standard error? He's wondering if the difference is small and if it's fairly precisely estimated.
Right. Yeah. So I presume this has to do with this last result that I showed. Yeah. So here you can see the standard error right in the slide. So
Okay,
yeah.
great. Thanks. No
No
more
problem.
questions for now. Thanks.
Yeah. Okay, so in the last part, I want to talk about the welfare analysis that we do that complements the empirical evidence that I just showed you. So here we develop and estimate a structural equilibrium model of bank credit, where we have a demand side, where there's firms that demand for credit from differentiated banks. And here we follow the standard structural IO demand estimation literature. And on the supply side, we have banks competing with transaction interest rates, but also banks rationing borrowers based on the expected default risk of these firms. So this is an addition that we provide relative to the literature because we allow banks to decide also to reject borrowers if they are above some riskiness level. We use the estimates of this model to perform two counterfactuals. So we use only the pre-consolidation period because that's when we have information on interest rates for all banks within a consolidated entities with a breakdown by each bank. We simulate the restructuring program just like it happened in the data. And we quantify the short-run welfare effects that this program generates if there were no cost efficiencies at all. And then we look at a long-run perspective in which instead we allow efficiencies to emerge. And here we allow two forms of efficiencies. First is a reduction in consolidated banks' marginal cost. And the second is a decrease in consolidated banks' default risk. And we want to find the reduction in these two outcomes that would be needed in order to keep the borrower surplus at the same level as pre-consolidation. So to be welfare neutral from the point of view of borrowers. So the demand side is pretty standard. So there's a firm I that demands credit from bank J in month T in province M, and its demand is given by its indirect utility that we express in this linear form that depends on some bank controls, the average loan interest rate that the bank offers, some unobserved bank attributes, and the standard type 1 extreme value shocks. We also let firms choose an outside option, which are some small fringe banks or cooperative banks in our data. And on top of this, we allow banks to reject borrowers if they are above some threshold of expected default, F upper bar JT. So this implies that every bank, J at time T, faces a distribution of potential default risk of its borrowers that follows a truncated normal with some mean and some variance and is bound between 0 and 1 because this is a share of defaulting loans, such that the market share formula incorporates the fact that banks can also reject some borrowers. So not all borrowers can access all banks. And this is in the spirit of Michel's Econometrica paper, because we generate this way heterogeneous choice set, and we allow banks to reject some borrowers, so not accessing some banks. Therefore, this complicates slightly the market share formula because it doesn't only depend on the mean utility that we get from the indirect utility function, but it also depends on the probability that a bank will reject a borrower below some threshold. On the supply side, we let banks set interest rate to maximize expected profits. And these expected profits follow the equation that I've written here that depend on 1 plus the interest rate minus the expected marginal cost, which will capture also cost for non-performing loans conditional on the threshold that the bank has chosen to accept, times the quantity, which will be the volume of credit that the bank gives. Now we will focus on this expected marginal cost and try to back them out from the first order condition of this profit function with respect to the price. And once we back them out, we can use this model implied marginal cost to run a regression model of the supply side, of the cost side, where we want to see how, to what extent marginal costs depend on bank characteristics, bank fixed effects, but also crucially for us on the quantity, the loan volume. And here, this gamma 1 coefficient, we capture the selection story that I described in the stylized model at the beginning of my talk. We want to see whether this coefficient is positive, which would imply an upward sloping cost curve. So as more loans are granted by the bank, the marginal borrower is riskier than the inframarginal one, therefore marginal costs increase. We estimate demand using an IV, standard IV logit model, where we include bank fixed effects, province month fixed effect, and use lagged MPLs as instruments for the price, following Egan or Taxu and Matbosk. We estimate firms' demand elasticity of being around minus 2.05, which is in line with the literature, with similar papers. The supply side, the cost model, we estimated by OLS, and we find a positive and significant coefficient gamma 1 on that quantity which implies that one standard deviation increase in loan volume corresponds to an increase in marginal cost of 43% of its standard deviation. So we show that the assumption that we made in the stylized model is actually proven by the structural model here.
Just to jump in real quickly, you have
Sure.
five minutes left.
Yes, that's
Okay.
more than enough. Yeah, great. Okay, so we use these estimates to perform two counterfactuals. As I said, one is a short-run counterfactual where we simulate M&As and SIP just like they happen without any cost efficiencies. Now, this implies that the only change that we make to the model is that we allow an M&A bank J that merges with bank J when it sets its price to maximize the joint profit of not only its own profits, but also the profits of the other banks that are part of the group. On the other hand, SIP banks, given that they're legally separate entities, they will keep setting their prices independently in this scenario. In the long run, instead, we want to find the reduction in consolidated banks' marginal cost or default risk that we name D here to keep the firm surplus as in the pre-consolidation level. Now, in order to do that, we need to establish a metric for firm surplus. And here we use the standard consumer surplus formula for the demand estimation literature, which depends on the inclusive value, so our estimates of the indirect utility function that I showed you earlier. But this is weighted by the probability of borrowers not being rejected, and also weighted by 1 minus D. This 1 minus D here is the survival probability of a bank. This implies that borrowers, when they consider their surplus, they value the fact that a bank is not likely to default because this bank will be part of their choice set this way, therefore will increase their surplus. So these are the results of our counterfactuals. On the top panel, you see the short-run results. On the bottom panel, the long-run results. I show you for the first 4 rows, the percentage change in interest rates, loan volumes, marginal cost, and bank profits for M&A banks. The other banks roughly don't change their outcomes. And then I show you for everybody the change in borrower surplus and total welfare. We find that on average, interest rates increase by almost 3%, which is quite similar to what we find in the reduced form evidence. We find the marginal cost decline, as we would expect. We find the bank's profits in the short run increase by 1.15%. This is roughly equivalent to 50 million euros. On the other hand, firm surplus decreases by almost 1%, and that's about 55 million euros. So total welfare drops by a very small amount of 5 million euros. In the long run, instead, we try to find what would be the reduction in marginal cost and banks' default risk that would keep firm surplus at the same level as pre-consolidation. And we find that this would be a marginal cost drop by 5.4% of its standard deviation, and a reduction in default risk by 56% of its standard deviation for both M&A and SIP banks. So let me conclude saying that in this paper, we measure the impact of alternative forms of bank consolidation on credit supply and credit performance. We use the Spanish experience of its restructuring program. We find that M&A banks' market power, as you would expect from an antitrust view, reduce credit volume, reduce quantity, and increase interest rates or prices, but at the same time, and this is a novel finding, their market power causes a reduction in non-performing loans, showing that market power can actually improve banking sector stability. We complement this with a structural model of bank credit that we use to quantify the welfare effects of these alternative forms of consolidation and simulate the long-run efficiencies that were needed to increase welfare, or at least keep borrowers' welfare neutral at the same level as pre-consolidation. So thanks.
Great.
Yeah.
Thank you, Nicola. Perfect timing. And now we're happy to hear from Daniel Pavanini, who's going to do the discussion for us. Thank you. The floor is yours, Daniel.
Stop share. Yeah.
Unmute. Okay. Can you hear me?
Yeah.
Yeah. Okay. Cool. Thanks for having me. So 5-minute comments. This also obviously only leaves time for kind of strongest impressions. So let me give my strongest impression from this paper. The paper, as you heard, explores how competition interacts with organizational form in the banking sector. I think it's a very important question. After the forced consolidation of savings banks in Spain, some banks merged, some banks they consolidated via business groups. And this paper shows that the type of organizational form adopted led to very different outcomes in lending price and future defaults. And the paper, coming to interpretation, the paper interprets these results through the lens of competition. The main hypothesis is that savings banks used to operate in an environment with very tough competition, This competition was hampered by consolidation, and all the results that follow were due to the increasing bank monopoly power, which is changed differentially for one depending on the organizational form of the consolidated entity. I find this assumption that the only competition changed is a very strong one, and this is where I'm going to focus my 5 minutes. In my view, there were at least two other important things that changed with the consolidation and the change in organizational form. First, the degree to which savings banks were captured by political influence, potentially, and these are all potential hypotheses. And the second, the lending technology that the banks could use effectively. So what I'm going to do is tell you two alternative stories to the competition one proposed on the paper, and I'm going to argue that both stories can deliver results that are very consistent with what the paper finds, but the interpretation would be different, and thus the welfare analysis would be very different as well. So story number one, suppose that before the consolidation, the savings banks was not characterized by very competitive banking sector, but actually for a very politically captured banking sector. This means that then the loan portfolios of these banks were loaded with loans issued with motivations other than profit maximization, political favor, corruption, loans to friends and family, you name it. This means, suppose now that also that consolidation led to an improvement in governance that reduced politically motivated lending. This is going to lead to a decline in lending, because at least in the short run, because as political loans are cut down, you're going to see that reduction, and then the proper profit maximizing loans are going to take time to build up in the long run. Second, is going to lead to an increase in loan prices. If politicians were giving cheap loans to their friends and acolytes, then that has to change. Third, a decline in defaults. Politically motivated loans are typically turn into non-performing. So the kind of the three results that you expect to find from this in this story are there in the paper. Which organizational form can lead to better governance? The authors argue in the paper that business groups gave a lot of autonomy to the banks and didn't meddle much with their lending processes, while mergers centralized decision making. Potentially, it's plausible that merged entities with their centralized decision making were better at steering banks into profit maximizing lending practices. So all the results that I mentioned above would be stronger for merged entities than business groups. So all the results fit this story. Of course, what would be very different is the welfare analysis. To do welfare analysis in this political influence lending story is extremely difficult, because you need to take a stance on what are the welfare benefits of politically motivated loans, and that's very difficult to do. And to do in a believable way. If you take the stance that politically motivated lending is bad for welfare, then there's no trade-off, and just simply mergers are better because they get rid of those the most. That's kind of one story that fits the data. A second story, I'll give you the short version because I don't have enough time, but the second story goes through a different mechanism. Suppose that before consolidation, savings banks were geared towards relationship lending. Relationship lending, think about the character loan, issued on the basis of soft information that's gathered and used locally and is difficult to communicate. Consolidation leads to centralization of decision-making. Centralization then forces banks to shift to a lending technology that's based on hard information, that is easier to collect and communicate. This should lead in the type of lending. If you think about, if you think relationship lending and arm's length lending as two segmented market, this is going to lead to a recomposition of the type of lending for these banks that you can potentially, and I say potentially because here the predictions of this alternative model are not super clear. You can actually make anything happen depending on how much each group is. You can lead to changes in lending, changes in prices, and changes in default. Okay, so kind of and of course then the question, which organizational form leads to more centralization in decision making? As the authors say in the paper, it's mergers. That's what basically leads to more intervention in how loans are done. So all these changes due to organizational form and centralization are going to happen more for mergers than for the alternative organizational form. And of course, the welfare implications are very special in this case because of the segmented market. You have different types of firms that it requires a richer model to characterize. So to summarize and to open the discussion, I agree with the authors that this is an important question, understanding how organizational form interacts with competition in the banking sector. It's extremely interesting and first order, but in this setting, I feel that there's many things changing at the same time to be able to pin down the findings to the changing competition. And of course, if you can't pin down the competition mechanism, then it's harder to take at face value the welfare analysis. And those are my comments. Thank you.
Okay, thank you. Right now, Nicola, we don't have any open questions from the floor, so maybe you want to take some time to respond or have other comments.
Yeah, sure, definitely. So Daniel, thanks a lot. These are great comments. These are very, very good points, and I totally agree with with your conjectures of this two alternative potential channels. So on the first one, on sort of this political capture that determined the bad governance. So I agree that this was the case for Spanish banks before consolidation, right? That was one of the reasons also that led banks that engaged in either one or the other forms of consolidation to be part of the program because of the distress nature distress level that they reached. Now, whether M&As, so if I understand correctly, your story, M&As would lead to a better improvement in governance relative to CEPR banks due to this more centralized nature that they have. So this would be something that I would say would be difficult to verify. It's a potential story, but it would be difficult to verify for us. I mean, what I know from the institutional evidence, and maybe Sergio can correct me if I'm wrong, is that together with this consolidation program came also a change in governance that was part of the legislation. So sort of the politically captured nature was to some extent eliminated or reduced because it caused this situation of distress before consolidation. So in other words, if consolidation also comes with an sort of improvement in governance that is led by the regulatory decision of the policymaker, then it could also be that they required similar rules for governing bodies, regardless of the form of consolidation. This doesn't rule out the fact that maybe M&As on top of that are better able at resolving their poor governance issues, but at least from the institutional evidence, that's something that I think we're aware of. And on the second channel on relationships, so I agree that could be a potential channel. I mean, I don't have a good story here to think of how we could measure this appropriately, whether the extent of relationship lending changes drastically between the two forms of consolidation ex post. We would need to think how we can actually measure that appropriately, but that's something that we'll try to keep in mind and try to address. Yeah, but other than that, thanks a lot. These are all great points and very well taken. Yeah.
Nicola, we have a question from Frank that's going to ask you right now. Go ahead, yeah. Frank.
Okay, I hope you can hear me. So
yes.
I just had one question. I thought it's very interesting paper and nice presentation. So I was wondering whether the upward sloping marginal cost that you estimate in the structural model, whether that could also be interpreted as being due to other reasons than the selection effect. So yeah, any other reasons that may be increasing marginal costs for just other reasons in the banking sector? I don't know exactly what, but maybe you have some thoughts about that.
Yeah, no, that's a good point. I mean, we try to control for as many other things as we can. So levels of assets that these banks have and bank fixed effects. But I agree that it could be consistent with other stories as well. I mean, what makes us think that it's consistent with the selection story is the results that we find in the reduced form, right? That suggest that as you change quantity, there's also a selection effect that we find there. So that's what makes us think that. I think Sergio wanted to add something to Daniel's point.
Yeah, I mean, I think that thank you, Daniel, for the comments. Very well taken. So I think that the first one is very important. We did something in one of the first versions of the paper. Of course, I mean, it's difficult, right, to identify political connections for all the firms that we have in our sample and the banks, right? But something that we did is to check at the municipality level who was the political party that was governing in each specific municipality, whether let's say the political party that was governing in this municipality was the same as the one in the region, that in some sense is at the level in which the decisions in some sense were taken, right? And we studied this for the pre-event period, and we found that there were no differences in terms of the amount of credit and the NPLs in this sense. That is, we don't see that in those municipalities in which the political party is the same governing in the region, the credit standards, let's say the lending was different. Of course, this is very difficult, but in some sense it goes you know, in that digression. So this is the closest evidence we have on the point that you mentioned.
Can I add something?
Yeah.
So thank you, Daniel, for your discussion, and thank you for providing these additional stories and interpretations. I mean, on the first one, to the extent that there is no difference between the two in the degree of political capture between the banks belonging to the two groups, what you're suggesting, an additional reason why M&A are good for welfare, and we already find that they're pretty good, actually. So the welfare interpretation you provide, if you want, is you know, bringing additional benefits to that organizational form that seems to do pretty well already with screening of bad guys. And we also see that from an ex-ante point of view, there is no difference to the extent of bad firms that are funded across the two groups in terms of risk. So I agree that that's something that can happen, but correct me if I'm wrong, it seems that it's even, you know, an additional reason why M&A are good.
You're asking me, I mean, you have to make an assumption about what are the welfare benefits of the welfare costs or advantages of politically motivated lending. And I don't have a prior on that. I mean, it could be that it substitutes for funding of political parties, which is something that enhances the more. I mean, I honestly don't have a prior. In the case where politically motivated lending is bad and reducing it is good, then yes. Now the number, of course, is going to be, you have to put a number of how bad it is too. But you're right in that sense.
If we don't have any other questions coming from the audience, I have a quick follow-up question, if you don't mind. So I noticed that the Q in your marginal cost is kind of how you think about the total loan amount and how that's varying with risk, that coefficient estimate. And when I asked a question earlier about how you deal with differential risk portfolios for just a big loan coming from one bank or a bunch of small banks. So what are your thoughts about how you could maybe do that in this methodology?
Yeah, no, that's a good point, and that's very important. I mean, one limitation of the structural model is that we are bound to the level of disaggregation in the data of interest rate, which is at the bank time level. So even though we see the quantities, you know, coming from going to different borrowers, we don't know which interest rate they eventually got. So it's a little bit difficult in the structural model to incorporate that dimension of large versus small loans. And so for this reason, we need to aggregate eventually. But that's, you know, that's an important point. I totally agree. Yeah.
Great. If there's are there any further closing comments you guys want to talk about? Okay, if not, then I say thank you. We say thank you. I say on behalf of all of the organizers and Nicola and Daniel, thank you for attending and for all of your comments. And on November 4th, just to advertise, Nicola Valodi will be giving a talk on ratings, design, and barriers to entry. So please come back in a week and participate in that. So until then, thank you. Bye.
Thank you. Bye, everyone.
Thank you, everybody.
Thank you. Bye.
Thank you.